Welcome to this explainer. Today, we're taking what honestly looks like a daunting mountain of regulations, specifically the Reserve Bank of India's 2011 and 2012 Master Circular on the Export of Goods and Services, and, well, translating it into a crystal clear, actionable roadmap. If you're an Indian exporter, or honestly just fascinated by the nuts and bolts of global trade, you already know that making the sale is really only half the battle. The rest is compliance. So we're going to unpack this incredibly dense regulatory framework and turn it into something you can actually use.
Okay, let's dive right into this scenario. Picture this. You've just finalized a massive international sale. The contracts are signed, the goods are ready to ship. You might be popping champagne. But in the eyes of the RBI, a highly monitored regulatory journey has literally just begun. We're going to walk through the exact legal steps you absolutely must take right after that sale. Because in international trade, knowing how to compliantly bring your money home is just as crucial as the export itself.
To make this massive rulebook digestible, we're following the chronological path of your export deal across 5 distinct stages. Rules of the export game, how you get paid, keeping your foreign cash, navigating the paper trail, and finally, when things go wrong.
Section 1. The rules of the export game, specifically timing and repatriation.
The literal moment your goods leave the country, a ticking clock starts. You are legally obligated to realize and repatriate your export proceeds within very specific timeframes. For most general exporters and status holders, you have exactly 12 months from the date of export to get that money back into India. Now, if you're exporting to a warehouse established outside India, you do get a bit more breathing room with a 15-month limit. But if your business operates out of a special economic zone, or SEZ, the rules give you a massive advantage. There's actually no specific time period stipulated for repatriation.
Section 2. How you get paid and the approved payment methods. Getting funds from a buyer in another country into your Indian bank account isn't as simple as a quick local wire transfer. The RBI allows a few standard methods to receive the full export value. You can use traditional bank drafts and checks. You can even accept foreign currency notes, provided your buyer is physically visiting India. Payments can also come out of funds held in the buyer's FCNR or NRE accounts or via international credit cards. But the golden rule here? Practically all of these transactions must be routed through an authorized dealer Category 1 bank. They act as the regulatory gatekeeper. However, there is another, much more modern payment method to talk about. Enter OPGSPs. The crucial point here is that AD Category 1 banks can partner with online payment gateway service providers to actually process your payments. This was a really significant move by the RBI to open up digital avenues for modern exporters. It allows funds to sweep into a Nostro collection account and then flow directly to the exporter within just 7 days. But hold on, there is a strict limit to be aware of here: $3,000. As of late 2011, the RBI mandated that this super convenient OPGSP digital gateway facility is exclusively for export transactions that do not exceed $3,000. So while it is absolutely fantastic for small e-commerce shipments or microservices, your massive freight containers, yeah, they're still going to require those traditional banking channels. There's also a geographic nuance to getting paid. If you're trading within participating Asian countries, payments generally have to be settled through the Asian Clearing Union, or ACU mechanism, using either the ACU dollar or ACU euro. But the RBI circular does note some specific exceptions. For example, trade with Myanmar can be settled in any freely convertible currency. And due to externalization difficulties at the time, trade with Iran was temporarily shifted outside the ACU mechanism to any permitted currency. Section 3. Keeping your foreign cash and managing Forex accounts. So once you actually get paid, you might not want to immediately convert all those hard-earned dollars or euros into rupees, especially if you know you have upcoming import expenses. This is exactly where the EEFC account comes in. The exchange earner's foreign currency account is your primary tool for holding on to foreign exchange earnings without immediately converting them to Indian rupees. It's an absolute lifeline for businesses looking to hedge against wild currency fluctuations. The rules around the EEFC are quite clear-cut. You're allowed to credit up to 100% of your foreign exchange earnings into this account. But there is a catch. It is strictly a non-interest-bearing current account, meaning your money just sits there, it's not going to grow on its own. Furthermore, the RBI strictly prohibits banks from offering any credit facilities, so no loans, no guarantees, against the security of the balances held in your EEFC account. It is literally just a parking spot for your foreign cash, nothing more. Now, while the standard EFC account is open to all foreign exchange earners with no specific turnover requirements, things change dramatically if you're in a specialized industry, like gems and jewelry. You might actually qualify for a diamond dollar account, or DDA. This is highly specialized. It requires a 2-year track record in the diamond trade and a massive average annual turnover of at least 3 crore rupees. If you qualify, you can open up to 5 of these accounts to handle your high-value, multi-currency diamond trades.
Section 4. Navigating the paper trail and the mandatory RBI forms.
Okay, we've covered the money. Now let's decode the bureaucracy. Think of this as your ultimate cheat sheet for navigating the paperwork. The exact form you use depends entirely on your specific type of export. For general physical exports, you use the GR form, which is submitted in duplicate to customs. If you're using the customs electronic data interchange, you'll use the SDF form, appended directly to your shipping bill. Sending goods by post? You'll need the PP form, and crucially, it has to be countersigned by your AD bank before you even step foot in the post office. And if you're exporting software, you must file a SOFTEX form with a designated government official within 30 days of your invoice. Now, I absolutely love this surprising regulatory cork buried deep in the circula. Imagine you're operating a deep-sea fishing vessel. Your catch is transshipped out in the middle of the high seas. Obviously, you can't exactly sail over to a customs office. So the RBI actually allows the GR declaration form to be signed directly by the master of the vessel. They effectively act as the customs certifier. It's just a brilliant, highly practical solution to a really unique logistical problem. Finally, Section 5, when things go wrong, dealing with delays and defaults. We all know business rarely goes perfectly according to plan, right? So let's start with a really common issue, short shipments. What if you promised 100 crates but could only manage to ship 80? The literal moment you realize this, you have to immediately give notice of the short shipment to customs. Then you take that certified notice straight to your AD bank to reconcile your GR forms. If customs is dragging their feet getting you the certificate, you have to give the bank a formal undertaking that you'll provide it as soon as humanly possible. The absolute key here is proactive communication. But what if the buyer simply doesn't pay? The number 10% is a critical compliance metric here. The RBI allows exporters to self-extend the realization period or even write off outstanding export dues entirely, as long as the aggregate value doesn't exceed 10% of your total export proceeds due during that specific financial year. It acts as a buffer. As long as you stay under that 10% mark, you don't have to jump through massive regulatory hoops just to clear your books. Now, if you do exceed your 10% self-write-off limit, things get a lot stricter. Your AD bank can step in and approve a write-off, but only if you meet one of these stringent, heavily documented conditions. The amount must have been outstanding for over a year. Plus, you have to prove that the buyer went completely bankrupt, simply vanished into thin air, or that foreign authorities actually destroyed the goods. They'll also allow it if the Indian embassy had to intervene to settle the dispute, or if you can definitively prove that hiring lawyers to sue the buyer would somehow cost more than the shipment itself. Sometimes the buyer isn't actually defaulting. They just genuinely need more time. If you hit that strict 12-month deadline, your AD bank can grant extensions in 6-month increments. But you have to prove that the delay is completely beyond your control. And crucially, you have to prove that you are not currently under investigation by the Directorate of Enforcement or the CBI. You also have to formally declare that you will eventually get the money and your total outstanding amounts cannot exceed $1 million or 10% of your 3-year average exports. There's also a really interesting safety net tied directly to the foreign trade policy. If you've exhausted every single option, the requirement to realize the proceeds can actually be waived entirely, provided, that is, you can produce an official certificate from the relevant foreign mission of India abroad confirming that recovery is completely impossible. It essentially proves you've escalated the issue to a diplomatic level. Finally, what happens in a worst-case physical scenario? What if your cargo ship actually sinks or the plane goes down before the buyer even pays? The RBI rule here is surprisingly pragmatic. You have to file an insurance claim immediately. If the claim is payable abroad, your bank will arrange to collect the full amount through an overseas branch. You must then repatriate those insurance funds back to India, and only then will the bank finally release and close out your duplicate GR form. And that brings us to the very end of this regulatory journey. We want to leave you with this thought to ponder. The RBI's framework is meticulously designed to protect India's foreign exchange reserves and ensure capital comes back home. But as global trade rapidly evolves and supply chains become exponentially more complex, you really have to wonder, are strict 12-month repatriation rules helping Indian exporters stay financially disciplined?
Or are they actually a constraint in an increasingly flexible and highly competitive global market? Thanks so much for joining us for this deep dive into the RBI Master Circular, and we'll catch you on the next explainer.